Good, thanks. Wanted to ask the class, now that we've been in going through, this is now week 8. Um, you know, would the class be open if I tried doing a pre-recorded lecture, either for week 9 or 10, or at least have have a portion of the lecture pre-recorded, and then people would view the lecture ahead of the class, and then we would have a shorter class on the Saturday. Is anyone open for trying to see how that would work? In other words, experimenting a little bit with the delivery. I'm contemplating doing that for at least 1 week in the course. I don't know if I can do it for next week, but it may be for the last week, week 10. Um, typically, uh, week 10, there's not as much interaction, like there's not as much challenging or asking questions of you guys. So I was thinking of experimenting with it for week 10, and maybe for that week it would be useful. Um, but anyways, we'll see how it goes. So I'll let you guys know ahead of time. Okay, well, just I think, although we're still getting kind of people filtering in, um, we'll just get started. Um, and go from there. So, how first off, how was the homework this week? Did you guys feel that it was fairly difficult, or did you think it was not too bad? Get some impressions on how you guys felt this week. How was the homework? Durzak is okay. Anyone else? Last question was hard. Many details. Yes. Well, I mean, Keegan and Yerk, this is tax, right? Um, and again, in any type of rules-based course, there's going to be a lot of detail. So, that's just the nature of tax, so it was okay. Okay, so what we'll do, so I think one of the things I want to um, emphasize, and I thought the best way to do it was to pull out take a homework that someone has done this week and kind of illustrate how you have to do things the right way to to really get the benefit out of the homework. So I wanted to look at, for example, here's 5-6. And so here's a student who they've put together a checklist, right? So, and the checklist isn't necessarily bad, but here's my question. Do you see any use of this checklist when you go and actually look at what was done for the case? More importantly, do you see them trying to apply the steps in the way that we should, right? So if you remember in class 14.1, it deals with intangibles, and we talked about a couple of intangibles in the class. And then we said you basically need one bucket for every business, for every line of business that the company has. So if there are multiple lines of business, you need to have multiple 14.1 buckets. So here the student has kind of tried to put this into a checklist But do you see it trying to be applied here? Like, is this student actually applying the checklist or using the checklist when they're actually doing the work? So I would say to you, Kijin, that I would never, I would tell you now, you really want to get into the habit of actually putting it down. Um, it's amazing how that works, but in many cases, just the act of actually writing it down kind of reinforces the discipline of having to be methodical every time you do it. It's really about developing the habit. So uh, a lot of times students think in a way, oh yeah, I'm thinking about it, but unless you actually write it down or type it down, the act of doing that actually forces you or gets your mind to keep practicing being methodical and orderly, and that matters. But do you see this student? Is this student really applying that checklist? Do you see any application? Kind of scary that the chat's quiet right now. There's no application, right? You take a look at this homework here, or this walkthrough, right? The first thing they talk about is, oh, I've got two businesses absorbed into one, right? So that tells you, oh, I should have only one. Here, this talks about it says how many businesses. And my question is, so what? Why does it matter? Like, this checklist doesn't help me because, and this is the key thing I think you guys have to understand. You have to, in your homework, when you're studying, if you're asking me, Chris, how do I do steps? And again, when I'm studying, where should my focus be? It should be on the criteria and what is the impact of each step. So if you sit there and say, how many business, that's not good enough. This doesn't teach me what I have to worry about. It's how many businesses, you could say something like, dictates how many class 14.1 buckets, right? And then I would have wanted to see something like, oh, in this one, there's only one business, therefore, only one 14.1 bucket. Something like that. Like I would want to see more constant application of more actual discussion of rules in the work. And if the question is, Chris, I'm not 100% sure, that's when I say to you, well, why don't you type out your steps? Why don't you type out the implications of each step? Send it to me, and then I'll take a look. But my biggest thing is if I don't see people trying, because one, they're afraid of making the mistake or not sure, then you're not going to, you're losing valuable practice. Okay. Hold on. I'm just going to bring this up, right? So, right? Because here in 5.6, here you have more text, and they give you independent cases. And in this first case, they tell you both businesses are absorbed. So there's only one line of business based on what they're telling you. Okay. Does that make sense? How do I know what's well, a step is what something you have to do when you analyze when you're taking going through the problem, right? So a step would have been in this case. First off, this first case is a trigger. Did I make a purchase of an intangible that did not have a limited lifespan? Yes or no? Okay. Now I need to, for class 14.1, I say yes. Okay. Now I have class 14.1. Now I need to assess how many lines of business are there, right? Because that's what you have to do in order, again, it's a criteria that you have to assess. For each line of business, you must have one class 14.1 bucket, right? So in this case, for example, in the first question, they've indicated, this student has indicated two businesses absorbed into the operations. Great. Now they're going through and now they're saying, okay, now I got to go through and do my normal CCA calc, right? Which is what they're doing here. And they sit there and say, well, everything here. Now, did this student do a great job? No. Why? Why am I saying that? Calculations look great, but I would have loved it if the student used all the general steps that we talked about in week 5, right? Like, again, resolving my additions and disposals, assessing whether or not there is recapture. When did I acquire the asset? Like, those steps are not listed here. Those general steps, they are applicable in any CCA calculation question. But the form in terms of how the buckets look and how those have been put together, those look good here. And again, I liked how the student has tried to put the key fact, and then you can see how they've applied that key fact in the homework. So there's some good things in here, some not as good things, not so good things, but for the most part, the student, this student is doing pretty good. Okay. So again, in question 1 or case 1, you've got a business, it acquired another business, but it merged, it had two businesses and it got all merged into one. So there's no separate line of business. They're telling you everything is just one business. So that means now everything is into one bucket. You don't see separate 14.1 buckets. They spent 161,000 at the end of the day. So that you put it together, right? For those are two businesses, 86.75. You have your AI bonus. They're at 5%. When you have a disposal in 2020, they tell you it's a portion of the business. They didn't tell you which particular business. And again, it didn't matter because both businesses were combined. So at this point in time, you just show, again, a disposal in the bucket. And when you sit there and say, what's the lower of cost and proceeds? Again, this is your cost, right? Your 161 is your cost. Proceeds is 90. So therefore, proceeds is lower. So you use that. And because you still have a balance, you still have UCC in your class, you just calculate your CCA on the remainder. Now, this is missing one key statement. Can anyone point out what statement is being missed? What's being missed? So they've indicated lower of costs or proceeds. What should they also state? What specifically about capital gain or loss, Harrison? Like what specific conclusion would I want to see in this case? Well, that's too general, guys. Like tax consequences, like what tax consequences? Like, let's be specific. What am I looking for? You tell me lower of cost to proceeds. You're telling me proceeds is lower. What is it that should not apply? Remember, we're dealing with depreciable property. What's the cardinal rule on depreciable property? No, they've shown that they've chosen the lesser one. That's not the issue. That's right. No capital loss on depreciable property, right? If you're remember what I said before, if you have cost as the lower of cost and proceeds, if capital cost is a lower number, then you have a capital gain. If proceeds is lower, then it means you don't have a capital gain, but it also means you don't have a capital loss. Because remember, we said before, you cannot have capital loss on depreciables. Okay, so you want to put that statement down where applicable, and again, you want to develop the habit to always think about that there is no capital loss on depreciables. Okay, so again, some minor issues here. Okay, any questions first off on part one, on scenario one? Yeah, I should make this bigger. Are you all good on scenario one? No, step one is not calculate recapture. Remember so if you go back to CCA, remember way back when, what did we always say to you guys? You had to resolve. Number one, you always had to figure out how many T accounts you have, right? So in the past, so if I were to recap the steps we had in the past, right? Step one was always about figuring out your T accounts, right? Because again, to do CCA calcs, you have to know your T accounts, right? So in before we said what? You had to worry about rental properties. Why? Because every asset is its own class. Class 10.1, every car, luxury automobile, the asset is its own class. Now you guys are seeing for class 14.1, oh, every line of business in its own class. So step one was always determine how many T accounts. And then step two, for each T account, now you have to resolve your additions and your disposals. And again, you had to figure out whether or not AI bonus applies or not. You had to figure out whether half year rule applies or not. You had to determine whether you had a capital gain or not. Then afterwards, you would say, then you have to assess whether you had recapture or terminal loss. Then you went through and calculated your, right? Then you looked at, right? You have to look at, sorry, I jumped ahead. But now, then you look at whether AI bonus or half year rule applied. Then you looked at calculating your CCA. Then you looked at whether or not there were restrictions like short tax year or anything else on your CCA, right? So you had to go through, you still have to go through all those steps. Anytime you do a CCA, it's just now you have 14.1 to add to your mix. Okay. And again, I mentioned to you guys in class, you guys have to create these steps yourselves and write them down yourselves. And then if you need to, send me the list and I'll assess the list. But you had to do it yourself. Case two. Using the same information as in case one, assume Moritex continues to operate both of the 2019 acquisitions as separate businesses, and that the $90,000 receipt for goodwill results from the sale of the first business. So the big thing again here is, in this case now, you have two T accounts because you now have two separate businesses. They're no longer combined. So now you have to do your calculations on an individual level, like you're seeing here. So you do the calculations at the individual business level. And then when you do 2020, it's only one, it's only business one that has the disposition. So business two, you just keep taking your CCA as normal. But for business one, now you sit there and say, what's the lower of costs and proceeds? So you're comparing between the $90,000 that was spent on business one initially, and then versus the 86,000 proceeds. So again, in this case, cost is lower. Okay, because again, you got $90,000. Sorry, I should say you got $90,000. Your cost was 86, right? Your cost is 86. So again, lower cost or proceeds, cost is lower. And again, because cost is lower, that means you have a capital gain. Because again, you got more than what you paid for, right? So 90,000 less 86, that's 4,000, 50% inclusion, 2,000 is your taxable capital gain. Okay? Does that make sense? Okay. Case three, you have during 2019, Mortex acquires a business. They make a payment of $96,000 for goodwill. Okay. Then it says here, the business is absorbed into Mortex other operations and is not operated separately. During 2019, Mortex acquires an unlimited life franchise at a cost of 113. So again, you have two intangibles, right? Because he's acquired basically rights to a name or to or rights to participate into a franchise. So when you have your additions, it's and again, you ask yourself how many T accounts, and they tell you because again, everything is absorbed into one business because again, he's saying it's not operated separately. So you only have one T account. All right, if you have one T account, two intangibles, your total additions is 209. Okay. Again, this was acquired. There's no recapture, no terminal loss. The business here was acquired after November 20th, 2018, right? So November 21st, 2018, beyond is AII. So again, it was acquired after November 20th. So therefore, AI bonus applies, calculate your CCA. You have your disposal. Again, what's the lower of cost and proceeds? Again, this is only one business. So therefore, cost is 209 versus 96. Okay. Actually, sorry, I should be careful. I'm not thinking properly here. In this case, um, because we've identified the assets separately, and they tell you the payment in 2020 was for goodwill, we know we spent 96 on the goodwill. So it should be lower of the 102, the cost of proceeds of 102, and cost of 96. So in this case, it's a 3,000, 6,000 capital gain, 3,000 taxable capital gain. Okay. Because again, in this case, we've clearly indicated that the payment of 102 was for goodwill. So we specifically identified it's for goodwill, not for the franchise. So it's 102 versus the 96. 96 is lower, so that's used in your CCA. 102 minus your 96, you have a 6,000 capital gain, 3,000 taxable. Questions there? Are you guys good? Okay. Number 4, using the same info in case 3 is assume instead of paying 102 for goodwill, you paid 102 for the franchise. So in case 4, again, it's the same thing. You only have one T account because the business is it's just one business. Okay. And again, your part 1, there's no change. It's all the same. Okay. 2020, the difference now is you were told that we spent 113 on the franchise. So when you do lower of cost or proceeds is 102, cost is 113. So in this case, the proceeds is lower. So again, you're going to throw the 102 into your disposal number. Okay. And remember here, it's key point here. You notice there's no, again, you're not showing any eligible, non-eligible, half-year rule AI bonus. Because remember, there's no additions in the year. You just have dollars coming out. So it's just disposals, right? So when you net, remember, when you net one thing that was an item that some people didn't catch. If I have no additions in the year, there's no AII bonus. There's no, there's no half-year rule because you didn't have any additions to apply those rules against. Because again, you net to a negative number in the year for your addition. Your net additions to the year is negative. There's no AII, no half year. So you just show the disposal and then you calculate your CCA. Okay. And in this case, again, because proceeds is lower, there's no capital loss on depreciable property. So I would have liked to see that statement. Any questions on this one? Yes, no, all good. Okay. So this is, again, there's no difference than the third case 3. It's all the same. Okay. Not hearing anything. Case 5. Again, similar fact pattern, but now what they've said is assume in this case you sold the franchise for 135. Okay. So again, what's your lower of cost or proceeds? Your proceeds is higher, right? Cost is the lower one. So again, throw in your 113 as your disposal, calculate your CCA. Okay. But here, again, cost is lower. That means you got more than what you paid for. You must have a capital gain. And so you would have an 11,000 taxable capital gain in the last scenario. But again, everything is just one T account because it's all one business. There's nothing being operated separately. Okay. So for this part wasn't difficult. This should have been fairly straightforward. Literally, the trick is all about just making sure you got the right number of T accounts. Everything else is the same. Okay, problem 8.8. Just going to scroll to that here in this PDF. Okay. So this student that I'm using their homework for made some pretty common mistakes. So what we're going to do is we'll go over the homework and let's see if you guys can spot the common mistakes that were made. Now, so in this question, they gave you a number of properties, okay? And I would say from a step point of view, there were some things that they did that was good, but I don't like this presentation because you need to do things in a certain order. So before we go into too much detail, when we go over, when we do PUP, so again, here they put in a trigger, did the taxpayer sell PUP? And remember, I would be more specific. We're talking about PUP and we're talking about LPP, right? LPP is a subset of personal use property, but still, because I know they're different, they get treated differently. I typically like to say, did the taxpayer sell PUP and LPP? Now, what criteria do you have to worry about when it comes to PUP and LPP? Because again, let's pretend we're trying to design steps. What is the criteria that you have to worry about? Or what are the steps or what are the things you have to do? So in the question, they gave you all this different property, right? They just given you all this facts about all these different properties that were being sold. What do you have to worry about or what do you have to think about when you're trying to put steps? So Tarantine says identify which one is LPP, PUP. Is that the very first thing you should do? Do you guys agree that is the very first thing you should do? Identify what properties are PUP and LPP. And why is this important? Like why do you care which ones are LPP and PUP? Why do I care? If anyone cares to use the mic or type. So what do you have to worry about if something is PUP? What's the issue with PUP? So no cap loss on PUP. What about if you have a gain on PUP? What's the treatment? We're not looking at floor rule yet. You guys are jumping too far ahead. The gains are taxable, but not just taxable. They're taxable as a regular capital gain, right? It's treated as a regular capital gain. You would put this in 3BI A if it was a if it's a capital gain on PUP. LPP, what do you have to do? So LPP, what do you have to do? So you have to calculate each item and then aggregate the impact. If you have a gain, what do you do with a gain? If you have a gain, what do you do with it? 3BIB? Again, Terry D, too far. I'm not worried about floor rule yet. We'll talk about floor rule in a second. So if you have a gain, it's a what? What do we call that gain? We call it a net gain, which goes into 3BI, right? And then you do 50%, and then that taxable net gain goes into 3BIB. If you have a loss, what happens with when you have a loss? No, LPP, you have something. No. Well, again, if we're already talking about the net number, so you net into a lost number, what happens? You get a loss carryover. So you get a LPP loss carryover, and you carry over at what? The taxable value or the gross value? Do you have a carryover at 100% value, or do you have loss carryover at 50% value? Gross value. That's correct. Okay. So when we're saying steps, well, why do I, again, knowing that you have different criteria for the different properties, right? When you do your steps, you sit there and say, okay, right, trigger. Okay, fine. So trigger would have been, did taxpayer sell PUP or LPP in the year? Okay. Then you sit there and say, I have different criteria or different rules to apply if it's PUP versus LPP. So obviously, because of that, because of the criteria, the differences in the rules, I need to identify whether each property is PUP or LPP. All right. Then what do you have to do? So what do you have to do after that? So now you've identified whether a property is PUP, LPP. And again, we said in order to discuss the consequences, you need to know whether you have PUP gains, whether you have PUP loss, whether you have, right? You need to know the gain and loss on the sale of the property. So is there anything you need to do before you calculate the gain or loss on the sale of every property? You have to look at the floor rule. And remember, what's the criteria? How does the floor rule work? How does the floor rule work? What does it specifically do? That's just a threshold, but how do you apply the rule? Right? So you sit there and say proceeds less than 1,000, push that to 1,000. Right? And if you want, then you can sit there and say ACB less than 1,000, push that up to 1,000. Right? So what I don't like about this here is, are we showing each step? Are we showing the thought process of what we need to do? No. This is just, let's just jump in and do the question. Whereas you're not talking about what's the order in which you have to do things. It's not explicit. Okay? Now, is this wrong? Well, again, when you know what you're doing and you've learned the material, this isn't the worst thing in the world. But when you're trying to learn the material, and more importantly, you remember you're in a rule-based environment. The rules dictate you have to do things in a certain order, right? This is not like this is a standard. No, remember, you're in a rules-based course. Tax is a rules-based system. You need to follow the rules in the order that the system dictates. So you want to practice that, and you want to, again, get into the habit of doing things in the right way. So really you should do that first. Then you want to sit there and say, all right, for PUP, right? Because remember, we said, okay, PUP, you look at each individual transaction. So you can sit there and say, okay, for PUP, calculate gain or loss. Gain is your regular taxable capital gain. Loss equals nil. For LPP, aggregate the results. Positive, apply 50%. Taxable net gain goes to 3BIB. And again, negative, do not apply 50%. Do not put amount in section 3. LPP loss carry forward. That gross amount. Okay. Does that make sense? Like we're talking about steps here. This is it. That's all your steps. Does that make sense? Right? Because all it is about criteria. What's the criteria? Right? What do I need to do to apply the criteria and to assess the rules? Okay. So this is, again, this is what you guys have to do every week. And steps is easy. You're literally just saying to yourself, what is the criteria? What are the things I need to do in order to be able to apply the rules? You have to previous courses in the program do not necessarily force you to be this specific. You can kind of generally apply the rules. But you have to remember, in real life, when you guys are out there in the workplace, you guys are going into a profession where you are being viewed as a specialist. So when people don't necessarily tell you everything you need to know up front, because they don't even know what you need to know, or they don't know the possibilities, so they're expecting you to come up with the possibilities. You have to have this organized approach and break the problem down. Okay. And you break it down into little pieces, which is what we're doing here. Okay, is that clear? Is there any questions? Any questions so far? Now, I will tell you up front, these are not perfect steps. If I use these steps in this problem, I would still make mistakes. Okay, but if you're saying, Chris, how would I approach things in the course and how would I study? Well, this is your first step. Now you want to sit there and say, let's apply these steps to the question. So let's go. Number one, they tell you he gives you a number of things here. They tell you, number one, you have a vintage automobile. All right, well, what is the vintage automobile? Okay, it's PUP. Then you have a coin collection. Okay, well, that's LPP. Then they tell you there's a manuscript. Well, that's LPP. They tell you there's a painting. Okay, that's LPP. There's a sailboat. Okay, that's PUP. And then you have an antique desk. Now, here, this student has said the antique desk is LPP. Does that make sense? Why? Well, let's look. Is a desk a print, etching, drawing, painting, sculpture? No. Is it jewelry? No. Is it a folio, manuscript, or book? No. Is it a stamp? No. Is it a coin? No. So number one, that's not LPP. That's PUP. Okay? It's furniture. So there's error number one. Number two, now we go through the calcs. Okay, let's go through the calcs. Oops. Okay, so let me just go into the individual ones. So they tell you, number one, he has a vintage automobile restored to like new condition. He acquired the vehicle for 42. He spent 135 on the restoration process. So question number one, what is the cost base? Is the cost base 42? Or do you add the 42 and 135 together to get to the 177? Here, this student said it's 177. Is that correct? Do you add it? Why are you adding it if you think so tomorrow? Why is it added together? Why is it added together? Like Desiree, why are you adding them together? Well, first off, 132,000, that's not a simple restoration. You're really modifying it. Like I would tell you now, it's not a repair, right? If you're spending that much money, you're not repairing the vehicle. Really, there's betterments that are being created with this restoration. It's going to increase or add to the lifespan of this car. Well, you don't just add it. Like if I said this was repairs, you don't add repairs to cost base. But in the case of this restoration, in a restoration, you are significantly adding betterments to the vehicle, and it is clearly going to increase the lifespan of the entire vehicle. So you would add it to the cost base because again, it's a complete betterment and it's adding to the lifespan of the vehicle. So for example, if say a car had a muffler, you replace the muffler. Well, that doesn't increase to the overall life of the vehicle. So even though it's a new muffler, you would say that's just a repair. Does that make sense? It's just that would be a deductible cost. You don't add it to cost base. But in the case of a restoration, it's like you're completely restoring the whole vehicle. You're dealing you're not just doing one component piece. You're you're doing a restoration of the whole vehicle, and in many cases, you're adding betterments to it. So therefore, now you're adding that to the cost. Does that make sense, Keely? Okay. So you have to understand why is it that you're adding it to the cost base. Don't just sit there and say it's additional cost added to cost base. There has to be a betterment for it to happen. Um, okay, so it is 177, so that's good. All right, and it's a regular capital gain, so you're seeing the 50% applied right away. All right, we said also the sailboat is PUP. Okay, so let's just do the sailboat next. So you had a sailboat 162, fair value 123. It's at a loss, and then we say NA, not applicable because no loss on PUP. Okay, antique desk again. He acquired it for 600, and he sells it for 22. Right? So again, okay, 600 for cost. Oh, we got to apply the floor rule. Okay? So instead of 600, your cost is now 1,000 because of the floor rule. And then with the 22, you get 1,200. So again, we would say, oh, you should apply 50% because it's capital gain. Correct? Does that make sense? Yeah. So now the LPP stuff. So first off, you have a coin, 23.5 fair value, 17.6. All right, no floor rules to worry about. Everything's over 1,000. There's your 5,900 bucks. The manuscript, mother paid 4,000. At the time of her death, fair value is 42. However, and then the value decreased to 85. Okay, so here's the question: is cost base at 4? Is the cost base at 4? Why is it you don't think it's 4? What's the issue? It's cost base. Is the ACB of the manuscript 4 tomorrow? Because you, what do you mean? What do you mean, Sarah? What do you mean you acquired it more? But no, mom spent 4,000. How do I acquire it at more? So, so what? What happened? You guys are you guys are telling me relevant facts, but you're not telling me what rule kicked in. Why are you so? It doesn't matter. Like at the end of the day, 4,000 in cash was paid. Mom gave it. I got it free, right? I'm Mr. Forenza. I didn't pay anything for it. It got handed down to me. So why are you saying to me that the 42,000 is relevant? What are you guys not indicating to me? What happened that you have to worry about? Something happened. You're right. Cost base should be 42, but why? Why did cost base have to be at 42? No, it's not timing. It's not timing. Tomorrow. So this is not about what's in the book. This is called integration. Multiple rules being applied in the same scenario. Remember what we said before last time. There are a number of events that deem a disposition. One of the events that deems a disposition is death. Okay? So, remember what I said about deemed disposition. In a deemed disposition, the person that held the property before the event was deemed to dispose. The person that held the property after the event is deemed to acquire at fair value. Okay? So in the case of Mr. Forenza's mother, what happened? She dies. All right. The minute before she died, she's deemed to dispose at fair value. So in Mr. Forenza's mother's case, in her personal tax return, what we call her terminal return, she would have declared a 19,000 taxable capital gain. Okay? I shouldn't say, I should be careful because it's not a taxable capital gain. This would have been a taxable net gain. Okay? Because it's LPP, right? So she would have had a taxable net gain of $19,000. Her estate is the person that gets the manuscript after the deemed disposal. Oops, I have a typo. Okay. So after the deemed disposal. So now the trust acquires the manuscript at $42,000 ACB. And then the trust distributes the manuscript to Mr. Forenza as a beneficiary. That's why he has an ACB of, that's why Mr. Forenza has an ACB of 42. Okay. So does that make sense? There was a deemed disposal at the time the mother died. That then caused the ACB to be pushed up to $42,000 for Mr. Forenza afterwards. Does that make sense? So this is what I mean by you have to worry about integration. So here's the rub. I'm going through my homework. Okay. Would this list of steps that we created, would this have caught that? So Keely, just think about that for a second. Okay, so again, you had a deemed disposal. You're dealing with LPP. Okay, you're dealing with LPP. Fair market value is less than cost. What happens? Right, you're the mother. You're doing your terminal return. Well, you have an LPP loss amount. And so is she going to be able to carry it forward? No. Can she carry it back? Maybe, right? So first off, you're going to sit there and say, I have an LPP loss carry back. All right. And then again, what did the rules say? Now the person that holds the property after the event, which would be the trust, would be deemed to acquire at fair value. Well, if fair value's gone down, then your fair value is impacted, right? So you're just going to have a lower cost base for the trust. Yeah. but the mom might be able to utilize that LPP loss carryback, right? LPP losses, I didn't say this, but I should have said this last class. For LPP loss carryovers, you can carry back 3 years. You can carry forward them 7 years. So carry back 3, carry forward 7. And the reason it's 7 is because when the government changed the life of loss carry forwards for non-capital losses, they didn't make the same change to LPP because they sat there and said, well, we don't get a lot of these, and there's no point increasing the lifespan. Okay. So that's just, they just made an arbitrary decision to make it inconsistent with non-capital loss carryovers. Okay. Or carry forwards. So this, so you do this problem, you realize, hey, my steps don't capture this. So you know what? That's right, Desiree. Carry back 3, carry forward 7. Guess what? We missed a step. But guess what? What do you think your step, what you have to really worry about? So the reality is, do you have to have some general steps when you deal with capital gains as a whole? And the answer is, when you see this question, the answer is, yes, you do. You can't just think so isolated for each topic when it comes to capital gains. So this question was designed to illustrate that. So you now need to step back. Okay. So if we were to step back for 1 second. And this is why I'm saying, you guys, we teach you rules, right? The textbook just teaches you rules. But the reality is, you need to think. You need to ask yourself, how can I simplify things? What makes my life easier? Now that you've seen this question, and now that you've seen a wrinkle, what is the number one thing you think you always need to look out for when you're doing capital gains? And you have to do this for every question. Every time you're doing a capital gains question, you always have to look out for this. What do you think you need to look out for in general? Because, and I'm saying this to you guys, right? You're in the exam. You don't know if you've got an integrated question or not. So how do you make your life easier? You need a general set of rules, right? How can you make it easier for you to identify stuff ahead of time? And remember, right, when I went over the midterm, right, that last long answer question, what did I do? Every time I went through and I was reading the question, anytime I saw a key fact that was potentially a trigger for something, I underlined it. So I was trying to identify what topics were in play as I was reading the question. So you're trying to do the same thing, right? What are the things that you need to keep in mind when you're reading a capital gains question? And this part's the hard part. If you got this stuff during the homework last week, bravo. General steps. Come on, guys, take a stab. I'm sure you guys are sitting there going, this seems hard, but take a stab. What was the issue here in this in 8.8? Why is it that we had this error? What was missed? What was missed? Not quite. So number one, you have to remember, right? In order for you to even get to a point where you need to calculate capital gain or loss, you need to actively say to yourself, did I see all the disposals in the question? Which means you have to be really familiar with deemed disposals, right? Those, remember, deemed means pretend, all the pretend disposals. Anytime, again, throughout this whole exam, anytime you go through and you see a question, you have to mark down the number of disposals in the question. The moment you see something about death, immigration, emigration, right? The moment you see anything like that, the moment you see change in use, immediately you got to sit there and say, wait a minute, that's a deemed disposal. I've got a disposition there. Okay? So number one, you have to identify all your dispositions. Number two, when you're trying to help yourself isolate topics. So if you understand all the triggers, at this point, you're in great shape because you can sit there and say, I want to identify all my disposals. I want to, I can see everything. I know every transaction out there. If you know your triggers for every individual topic, you're in good shape. But say you want to try and help yourself isolate or reduce the number of possible topics. Say you're not 100% sure on something. What type of things can help you reduce the number of topics in play for any particular situation? What are some of the things that make the various rules that we've talked about in the course unique? Is there anything that's restrictive? And again, why am I bringing this up? Because this helps you with triggers. My favorite word, triggers. Why am I saying this? Is there a gain or loss on the transaction? Let me ask you this question. This past week, for the rules I've taught you, do they always apply whether you have a gain or loss? Or did certain rules only apply if you have a gain? Or did only certain rules apply if you have a loss? Right? Like if we list out the rules we talked about, replacement property. If you have a loss on the transaction, are you going to apply the replacement property rules? Like if I have a if I have zero gains or zero recapture, is there a point? No, there's no point. So you would sit there and say only applicable if you have recapture or capital gain. Okay, capital gain reserves. Is that going to apply if you have a capital loss? If I have a loss, are you going to care about these rules? No, right? Because again, you have to have a capital gain and not receive all your proceeds up front, right? So again, only applicable if you have a capital gain. PUP, LPP can apply regardless. Okay, so PUP maybe not, but you notice how some things can only apply if there's a gain, and some things can only apply if there's a loss. We're going to go more into that this week, but that is something to think about. And you'll see more of this week, type of property. So again, some of these rules will only apply if a particular type of property is present, right? PUP, LPP, it's got to be personal property. We'll talk more about principal residence, right? So that's more of a housing property, right? We'll talk about able today. Well, that's a specific type of share, QSBC shares. Okay, so I want you guys just to be careful and just remember, no matter what, there are some things you always have to do. And one of those things is you have to always identify your disposals. So you have to identify all. Okay. So in this case, the student here did not identify all the disposals. So therefore, there's a deemed disposal, but they only put in 4,000. They didn't put the 42. Okay. So that was not very good there. Okay. But overall, I mean, again, it's an honest effort, so can't get too fussed about that. Okay. And again, that was one of the tricky points in the question. So not everyone's going to get it. But you gotta, again, this is a key thing. So here I should have said, oh, you know what? My misstep is I needed to identify all disposals at the start. Okay, so as I apply my steps and then I find I make mistakes, now I need to add to the steps so that I can correct those going forward. Okay, so does this make sense now in terms of how I'm saying you apply your steps and then now you see something you missed and so now you need to add to it, but this is why you need to apply your steps every time in a question so that you're always complete and then you learn when you make the mistake. Is that clear, or am I showing you guys what you want to do when you do your homework? Seamus says yes. Don't see anything else from others. Like for the rest of the people, does this feel intimidating trying to do this? I guess is the question. I mean, it may be intimidating. So this is why I'm saying to you guys, don't be afraid to do your steps, then send it to me to review. And I just want, again, I have to reiterate this. When I did everything for the class, I can tell you the averages are lower. So, and most importantly, you guys need to try and learn this stuff on your own, because if you can do this for this course, when you go to your more advanced accounting courses and this type of approach is helpful, you'll be able to do it on your own, because a lot of instructors will not walk you through this. You gotta learn how to do it, because everyone's focused on just teaching you the rules themselves. How to structure it and how to think through them is something that's helpful if you can do on your own. Okay. Okay. Anyways, I have to keep going. So I'm just going to show you the corrected. So it's PUP. So now we have all our numbers. What happens? Well, your coin, your manuscript, your painting, you net to a negative number. So again, we're not going to put this into section 3. It becomes an LPP loss carry forward of 22.6. You don't show anything in 3BIB. Other thing is, generally speaking, you should practice your section 3 format. So this student here, for example, I'm not happy with this because this is bad habits. And again, in the midterm, bad habits cost people. So I would have wanted to show the whole section 3. 3A is nothing. 3BIA is these two numbers combined. right? Your desk capital gain, your automobile capital gain. So that's 72.1. Nothing in 3BIB, nothing in 3B2 little I, your 3B total 72.1. And again, NITP is positive, so you say 3E, NITP 72.1. Okay. Any questions there on 8.8? If you're talking about within section 3, you can do that if you want. If you want to sit there and say 3BIA is automobile 71.5, antique desk 600, then that's fine. That's fine. We won't, like for the course, we're not going to get fussed, right? If you're talking about a software program, the software program just aggregates it all and then puts into one line. But again, we're not going to get fussed for the course. Harmon wants to see the steps again. Again, you guys, I would strongly encourage that you guys try and do this on your own. Don't just look at what I'm giving you and trying to memorize it. You need to understand, right? But here, there you go. Okay, just tell me when you're good, Carmen, so I can move on. Okay, thank you. Okay, 8.13. So replacement property. So again, if I were to talk about to trigger, is it disposition occurred? No. It's does that revised trigger make sense to you guys? For replacement property? It's not just that a disposition occur. And let me ask you, why is this part, why do I have to put this part in? Does anyone remember? Why is this important? Why is this important? That's right. So part of it, Joshua, as you said, there's a choice. But more importantly, why am I saying what could cause you not to make the choice to apply these rules? Remember the discussion we had at the beginning of the lecture on replacement property. Why is it that you might not make the choice? Right? We talked about this last class. Why it's not just the fact that it's optional. Why is it that you might not want to minimize the upfront tax? Like why is it you don't want the deferral? What's the benefit if you don't do? You lose out on CCA. That's right, right? Remember? If you are willing to pay the upfront tax hit, especially in a situation where you are generating a capital gain, the fact that you can put the full replacement cost into UCC when you get the replacement means you will actually have more CCA that you can deduct, and the CCA deduction will exceed the amount of tax that you paid. Right? The value of those deductions over time will exceed the amount of tax you paid. But if you apply these rules, you're going to lose out on some of the additional CCA you could have gotten. Okay, so we walked through that last class. So that's why it's important to say you're only applying these rules if there is a desire to minimize the upfront tax. And when you look at 813, let me just move over to 813 here in this PDF here, the second in front of me. When you go through and you look at 813, it says right here, right? If I look at the text of 813, right, it says Canco would like to minimize any capital gains or recapture resulting from the sale. So here, the question is specifically telling you, guys, we want to minimize the upfront tax. So that's a trigger. That's part of your trigger to say, I've got to worry about the replacement property rules if they're saying they want to minimize the upfront tax. Okay? So that's really important to understand or to look for in replacement property. Okay, so they tell you in the question, okay, we look at the question. You have Canco. It had land and building. It had Class 8 assets. Okay, building was constructed. Total cost 2.3. UCC 1.105. And it tells you the building is situated on land. The company purchased this for $250,000. Okay, company purchased this for $250,000. Class 8, there's some furniture equipment. Cost is 230, UCC 178, 645. Okay, so just there's some facts there in the beginning. Then it says to you, it operated a retail outlet. But then they said sales decreased and they had better online sales. So they wanted to close the store. And then they relocated to a site in Sudbury. So this tells you right away, this is a voluntary disposal, right? Because remember, voluntary meaning you had control, you made the choice. So this was a voluntary choice, voluntary disposal, okay? So that means you have to remember now, in terms of criteria, you have different there are different time frames that are available to you if it's voluntary or involuntary. And we'll talk about this later on. I gave you guys some initial steps, but the reality was you could have taken those steps and you could have improved upon it, or you could have made some addendums to those steps so that they could be more functional for you. Okay, but we'll talk more about that in a second. So they tell you 2019, they sell the land and the building. They got 3.2 in total. Of the 3.2, 800,000 was relating to land. 2.4 million allocate to building. And they tell you Class 8 assets were sold for $200,000. 2020 comes around. They purchase the Sudbury property for $3,080,000, of which 2.48 is building, 600 allocated to land. As it is not a new building, they tell you it is only applicable at 4% CCA. Okay, so in other words, you cannot do 6%, you cannot do 10%, you can only do 4%. They tell you they buy new furniture and equipment for $275,000, and they tell you that all the equipment is stored and moved to the new location. Okay, tax year end is December 31st. Okay, and then they just said that, and then they just gave some more details why the replacement was 2020. Okay, so remember what I said in class, where you have a situation where disposal occurs first, proceeds occur, or sorry, replacement occurs after the fact, you have to calculate your tax, the tax in 2019, because you did not yet meet the criteria by the time you file, by the time you hit end of 2019. Okay, so let's go through. So we calculate the capital gain, okay, and recapture. Now you have 2.4 million that they told you was for the building. You spent 2.3. That's 100,000 capital gain. Okay, you spent 800,000, or you got 800,000 for land. You originally spent 250. You got 550 capital gain. Okay, they tell you sold furniture for 200, but the ACB was 230. You have a loss, but again, capital loss is denied. So therefore, no capital loss, right? Because it's depreciable property. So again, what I would have liked to say is capital loss, right, on depreciable property. Okay, oops. Are we good so far? Okay. So now we go through and we say, okay, let's go and figure out recapture. So again, they tell you your opening UCC is 1,105,000 for class one. Again, lower costs or proceeds, right? Proceed cost is lower, sorry. So therefore you have 1.195 recapture. This was the opening UCC for the equipment. Again, lower of cost or proceeds. You got 200 for proceeds, right? So that's lower than the cost of 230. So you put 200. You have 21,355 negative. So you guess what? You have recapture. Okay. So you have recapture on both the equipment and the building. In total for the year, you had 1.216 million recapture. Okay. Now we buy the replacement. And by the way, who remembers when do you have a disposition? What condition must be met for a disposition to occur? Does anyone remember? What condition must be met for you to have a disposition in this circumstance? No, not quite. I mean, you're kind of there, but I think you can be a little more specific there, Hoy. A little bit more specific. I would say when the amount is known, when the final proceed amount is known. Okay. So why do I say? Why am I saying it in that way? Remember, in real life, in some cases, an insurance company might say, "Oh, you're asking for 10 million. You think 10 million would be what would be the amount under the claim? We agree that at least we will owe you at least 2 million, but we don't necessarily agree with you on 10. We'll advance you 2, and then we'll still work through the rest of the claim, right? So you can get proceeds that become receivable from the insurance company, but that doesn't mean that there's an agreement on the final amount. So again, remember, disposition occurs when the final amount that's going to be received is known, and that could take years. Okay, does that make sense? Like, does that help you there, Hoy? Okay. All right. So, one of the things that I think is really good for people, just to make sure they really understand timing, is don't just say that you have a 1 year time frame. right? Remember, it's 1 year from the end of the year in which the disposition occurred. So I would really encourage you guys, write it out more fully. So here, what I've done is said, disposition occurred in November 2019, and Canco has December 31st year end. So therefore, Canco must build a replacement by December 31st, 2020. So I'd like to actually be that specific to make sure I'm really understanding the rule, right? Because sometimes people think, oh, it's 1 year from November 2019. It's not 1 year from the disposition. It's 1 year from the end of the taxation year in which the disposition occurred. So you don't have until November 2020, you have until December 31st, 2020 to build the replacement, okay? And then what I've said here is now once we've attained the replacement January 2020, therefore we've qualified, okay? So I want to encourage you guys to be specific when you are documenting or doing the homework to make sure that you really understand the rule as it is, okay? Like again, when I look at other homeworks, like again, if I pull the initial homework that was done here, you know, like again, to me, this student here, it's just too, this is too general, right? There's no discussion on timeline. It's just saying, oh, it's a voluntary situation. So again, you need to be, I would just say, although I can see an attempt at steps, what I really want to see is more specificity in the homework, more attention to detail, okay? All right, so now we know we can file our elections. So remember, the question has always been, take a look at the replacement cost, show the deferral of the gain or recapture, and the question is, are you below where you were before? And remember, the concept of replacement property is we want to take you back to where you were before. If you spend more than what you receive, you're going to get credit for that. If you spend less, then there might be a cost. Okay? You might have a capital gain that must be recognized. So first thing I want to look at is let's look at the building. Okay? Because remember, you had both land and building. Okay? So if we look at the building, what do we spend to replace the building? Okay? So they tell you for Sudbury, okay, you spend 2.48 for the building. So, okay, what was the capital gain on the building? Okay, capital gain is $100,000. Okay, if I defer that, I'm now at 2.38. Is this higher than my old cost? What was my old cost? Oh, it was 2.3. Yes, it's higher. Great. I should be able to defer the whole capital gain. Does this end number make sense? Well, my old cost was 2.3. I got 2.4, but I spent 2.48 million. So I spent 80,000 more than what I received. Well, 2.3 plus the 80,000 extra I spent. Oh, new cost base 2.38 million? Yes, that makes sense. Okay. Okay, now let's look at recapture. If I defer the whole 1.195, I'm going to get a new UCC of 1.185. Is that higher than my old UCC? Well, yeah, my old UCC was 1.1. Again, 1.105 plus 80,000 extra spent, I'm going to get 1.185. That makes sense. Okay, that is my new UCC. Okay. So again, now we go through and we do the calcs. Again, 1.185 for additions. Okay, we can apply AI rules. So because we can apply the AI rules, you're going to get 71.1 CCA. And again, only at 4%. Okay, does that make sense so far? She says yes. Other people? Okay. So we got a whole bunch of yeses. All right. Now, here's my question. This student thinks they're done. What am I missing? What am I missing? We've done the building. What are we missing? Class 8? What's the problem with Class 8? Can I apply replacement property rules to Class 8? No. Remember, voluntary disposals, you cannot apply the replacement property rules because voluntary only applies to real property. So, is there something we could have improved here? Well, we didn't apply the criteria. We didn't list here. There's nothing here that tells me the criteria only apply for voluntary, only applies to real property. So we're missing something here, right? Either we should, right, in this step, either we should put in the criteria, right? Voluntary. If it's voluntary, assess applicable properties, right? And then just put in here only real property, aka real estate. I shouldn't say, I should be careful. For you guys, when you hear the word real property, you guys will think real estate, but only real property would be applicable. Okay. Okay. So machinery and equipment does not qualify. So for Class 8, you would just say, okay, we acquired, right? If I were to just, let's just copy this, right? If I did Class 8, right? My additions based on the question, you would just say what they bought 275 of equipment, okay, and your CCA here would be 20%. You're going to have 82.5 of CCA. Does that make sense so far? Okay. What else am I missing? Because there's something else that we're missing here. All right, we dealt with the building. We dealt with Class 8. What else do we need to deal with? All right, the land. So if we do the land, oops, what do we spend to on the land? It said here 600,000 was spent on land. Okay, so if we do, actually here, let me just, okay. So again, if I just copy this, okay, okay, we spent $600,000. Okay, we spent $600,000. What was the capital gain on land? Okay, it was 550,000. If I defer the whole capital gain on land, what happens? I only get a $50,000 cost base. Is this less than what I had before? Well, my cost base before was 250. Oh, guess what? Can I defer the whole gain? No, I can't. Because remember, I cannot go lower than where I was before. So my ACB cannot be below 250. That means the maximum that I can defer is only 350 because my ACB cannot be below where I was before. And you think about it. So if I can only defer 350, my end capital gain that will stay in 2019, right? 550 less 350 is, right? Because this gets deferred, 200,000 is going to remain as a capital gain in 2019. Well, I got 800,000. I only spent 6. I kept 200,000. Well, guess what? That 200,000 is staying as a capital gain in 19. Okay? So, in the case of the land, you cannot defer everything because you cannot get your ACB below where you were before. Does that make sense? No, you can defer it on, it's capital property. It is not just on depreciable. If you look, I think, and let me just go back to the examples that we talked about last class. So just give me 1 second here. I'm just gonna go to the examples in last class. So last class, I think it was we did exercise 8. Oops, I'm in the wrong chapter here. Hold on a second here. Just gonna pull it up on the screen. Okay. So what might cause the confusion is that in these exercises that we covered in class, they wanted to ignore land for the purpose of illustrating the rules. So they've indicated here, ignore any gain or loss related to land. But that's more because they wanted to just focus on the building, the depreciables. But that didn't mean that you don't apply the rules to cap. Like, it's all capital property. And if you actually looked at the book, they talk about land right here. So you can do it again on land. Okay. If that helps you there, Joshua. Let me just bring myself back to. I don't need chapter 5 anymore. So let me just get back to that problem here. 13. Okay, so hopefully that alleviates the confusion there. Okay, so we dealt with the land. And just by the way, right, the principles are still the same though, even for land. Just land, you don't worry about recapture because it's not depreciable property, right? Okay, last bit here again. You got to state that you're actually filing the election and what is the impact. Okay, and again, the key thing is you're going to affect the 2019 tax return. You're basically saying to the government, can you refund me the taxes I paid with respect to the 2019 tax return? Okay. So that's the last step. Okay. Any questions on replacement property rules in general? Does this all make sense, or does this better sense now for 813? I think, like, I can't remember if it was SEMA that I think was saying it was more difficult. But I'm hoping this, like, I think it was you, SEMA. So, SEMA, does this help? Okay, but so you didn't have any problems with 813 at all. You were fine with 813. Okay. All right. Okay, so let's go to 814. So in 814, okay, if I read the problem here, you have and you have Context Limited, a pubco, December 31 year end. It had a building where it acquired things at a total of 1.782 million, of which 400 is land, 1.382 is building, and they tell you UCC 985926. Then they tell you building gets destroyed, and it was destroyed by a fire, right? So again, this is not something you had control over, right? The assumption here is you didn't do arson. This was not something where you tried to destroy your business for insurance money. This was just a legitimate, something happened and a fire occurred. And the company sells the site and it goes and looks for a replacement site. Okay. They tell you they got the money in 18, 19, they get the replacement. Okay. 1.7 to building, 800,000 to land. Okay. And then they tell you 100% non-residential, but no MNP, no manufacturing processing. So that, remember, that's to tell you use a 6% CCA rate. Okay, because remember, class 1 has 3 rates. 10% is non-residential building, 90% space used for M&P. 6% is non-residential, less than 90% used for M&P. And then the base rate is for everything else, which is essentially residential buildings. Okay, and again, you must acquire after, I think it was 2007. Okay, so now again, and in the question, and then I think again they want you to go and pursue the elections. Okay, so again we're going to go through, and in 2018 we have not yet met the requirement for replacement property rules, so we have to report the tax result. So again, we're going to calculate the capital gains, right, and recapture that might result. So again, we get 1.6 million proceeds, right, for the building. My original ACB is 1.382, so I've got 218,000 capital gain. I have 550,000 for land for proceeds. Again, cost base was 150,000 capital gain. Okay. Now we look at recapture, 985926. Again, lower of cost or proceeds. Again, cost is lower. That's why you've got your capital gain. You got 396,074 recapture. Okay. Again, are we good at this point in time? Okay. Now remember, if I gave you equipment in this case, can you apply the replacement property rules? Yes, you can. Okay. In an involuntary situation, it's all capital property that you can apply these rules against. Okay. So we didn't test it necessarily in this question, but you have to remember, in general, on an involuntary, you can apply to all the capital property. Okay. So now we go through. Okay, so again, could we do this better? Sure. Right? Because again, you would sit there and say, when did we have our disposition? Right? You would say disposal occurred October 1, 2018. Because there were replacement, this is involuntary, right? 2 years from the end of the taxation year in which disposition occurred. Again, December 31st year end is 2018 is the relevant year end. So 2 years from that is December 31, 2020, right? So for involuntary, replacement must be obtained by December 31, 2020. And We got the replacement in 2019, so it qualifies. Okay. But again, replacement must have been done by December 31st, 2020. Okay. So now we want to go and we qualify. We now want to, and then again, here it would be nice to say involuntary, all capital property is eligible for replacement property rule treatment. Something like that. Okay. All right. So now you go through and we sit there and say, what is our new cost base? So again, what do we spend to replace? We spent 1.7. We had a 218 capital gain. My new ACB is 1482. Is that higher than where I was before? Where I was before is 1.382. Okay. I spent 100,000 more than what I received. So 1.382 plus 100,000 is 1.482. That makes sense. We're good to go. Again, now you defer your recapture. Your new UCC is 1,085,926. Well, my old UCC was 985,926. So that's great. I'm above where it was before, right? And again, this number plus $100,000 is the 1,085,926. So that makes sense. Okay. So now again, for your building, you're doing your calculation of the UCC. It would just be, again, 1,085,000. AI rule would apply, 6%, 97,000 CCA. Okay. If we were to do the land, again, for land, if we go and we copy this over, okay. So again, for land, how much did we spend for the replacement? We spent 800,000. Okay. What did I defer for the capital gain? Well, on land, we had 150,000 capital gain. Okay. My new ACB is now 650. Does that make sense? What was my old cost base? Oh, my old cost base was 400,000. Okay, so I am above where I was before. And again, my original cost was 550. I spent 250,000 more than what I received. Is that right? Sorry, did I put the right number? Right, 800. Blah, blah, blah. Yeah, sorry. My original was 400. I spent 250 more than what I received. So therefore, my new cost base is 650. So that makes sense. Again, where was I before? 400. I spent an additional 250. So 400 plus 250 is 650. So that this new number makes sense. So there's land. Okay. And again, we're now filing the election. We file the two elections because it's recapture and capital gain. We're reversing the 396. And again, it's not just the 218. So you're reversing the 218 on the building. And also, you're reversing 150 on land. Okay. And here's the other issue. Is the taxation years correct here? No. Because again, when did disposition occurred? When did disposition occur? Did the disposition occur in 19? When did disposition occur? No. Remember, when did you have the fire and when did you sell the site and know your proceeds? Yeah. So one of the issues here is, and then there's some errors in the facts here, right? UCC was not 2019 UCC. This was 2018 UCC. So you got to be careful on your timing here. So again, this should have been 2018. This would have been 2018. Okay. So you have to be careful on timing. This is opening UCC 2019. Okay. So again, 2018. Okay. And again here for 2813 as well. I'm not just reversing 100,000. This is on building, and I'm reversing 300,000 capital gain on land. Oh, sorry, not 300. 350. 150. Okay. Does that make sense? Does that help you out there, Seema, on the last one? I'm not sure which particular area that got you that was difficult for you, but did this help you there, Seema, on the very last question? Okay. But you have to remember the process is exactly the same whether you do involuntary or voluntary. So if you didn't have problems with 813, you basically shouldn't have any problems with 814 because you're basically doing the same thing. There's literally no difference. The only difference was in 813, besides the fact that it's voluntary, on the land they spent less than what they received. Whereas in this one, you actually spent more than what you received in both the land and the building. So it's there's only, I'll say, minor differences really between the two scenarios. So like hopefully if you got 813, 814, it's really not that much different. So hopefully you won't get too much difficulty there. Anyways, so that was the problem set for this week. We taught you guys capital gain reserve rules last week. They're part of this week's homework. This week, I think, is going to be a little bit of a lighter week. At least that's the hope. And so we kind of shifted the homework around a little bit. Okay, so right now it's about 10:54. I'd like to do a 10-minute break. So I'd like to say let's resume at 11:05. And Claudia, again, I just want to just put it out there, Claudia, I'd like to have a discussion with you after this class. And then as well, I got one or two emails where people were wanting to maybe chat, or it sounded like to me it makes sense for people to chat. So again, we'll have some time to talk to to do some one-on-ones at the end of this class. So again, 10-minute break, 11:05, we're going to resume. I should know we're at 11:06. So let's just get started here. So the plan now that I've got is we want to go over some of the new stuff for this week, and then have some, I'll call, catch up well, there's some catch-up items that we need to do. So, so we're probably going to do some, I'll say, catch-up items. I also want to talk about a presentation, and also want to talk about kind of what we're going to do, marking certain things going forward. So we'll talk more about participation going forward. Um, so without further ado, let's just get going on the new stuff here, and then once we're there, we're good. Last week, I think we also there was a handout from last week that had the LPP, PUP, and then that handout also had ABLES. So we're going to refer to that handout in this week's lecture. So you'll need one of last week's handouts as well, because we'll go over that uh, um, in the class. Okay, so in terms of new topics, the first thing is what we call ABLES. Now, this is something that you really need to know for this, not just for this class, but you need to remember this for 4410. So there are some rules that that are around investment in Canadian small business, and some of the rules interplay with each other. And in the case of ABLE, it interplays with the capital gain exemption rules that you learn in 4410. So, you can't forget these rules that you're being taught right now, for sure. They definitely will come back in 4410. Okay, so without further ado, let's explain what these rules are. So, the Canadian government wanted to encourage Canadians to invest in Canadian small business. And so they created two rules to do that. And basically, they operate on either side of the spectrum. So the capital gain exemption rules, what those rules say is, if you invest in a qualifying Canadian small business and you make a profit on that qualifying investment in the Canadian small business. So say, for example, you hold shares and you sell the shares and you generate a capital gain. Okay? Then up to a certain threshold, the capital gain will be exempt from tax. Okay? So up to a certain threshold, the capital gain will be exempt from tax. On the flip side, the government said, let's say you make an investment in a small business and you lose money. You incur a loss. Okay? The government said, well, normally, if you recognize a capital loss, you can only apply that capital loss against capital gains, right? The general rules in 3B. So the government said, well, why don't we, for these losses, losses associated with these investments, why don't we let you use them against other sources of income? So in other words, if you invest in a qualifying Canadian small business and you end up generating what would normally be a capital loss, why don't we reclass this loss into 3D, and now you can use it against other sources of income. We'll give you greater flexibility in utilizing a loss resulting from an investment in a qualifying Canadian small business. That's what the ABLE rules are. Okay, so I want to make it very clear, because sometimes people take this course, with other instructors, and the instructors just jump into the rule. The end result of this is a reclass. You're not creating a new loss. You're not creating additional losses. You're just reclassing a loss from 3B, 2 little I, to 3D. And by doing this reclass, you allow the loss to be able to apply against other sources of income, not just capital gains. Okay? So the government gave you was giving a benefit on the gain side and on the loss side. Okay? And the government said, we don't want to give you too good of a deal. And they said, if you got a benefit on the gain side in the past, then it reduces your ability to get a benefit when you lose money on a qualifying Canadian business. And it's vice versa. If you lost money and you take advantage of these ABLE rules, right? When you made an investment in the Canadian small business, if you lost money and you took advantage of these ABLE rules, then it will limit your ability to take advantage of the capital gain exemption rules at a future time. Okay, so these rules interplay with each other in that if you get a benefit on one side, it reduces or makes it more difficult to get the benefit on the other side. Okay, and we'll illustrate some of this in the examples that we go through. Okay, so first off, before you jump into these rules, the question is, what qualifies? What type of investments will qualify? Number one, the question is the Canadian business that you've invested in, is it considered what we call an SBC, a small business corporation? Okay, this is a defined term in the Act. So this is for ABLE. So for ABLE, so you gotta remember this, for ABLE, the question is, are you dealing with an SBC? When you learn about the capital gain exemption rules in 4410, the question is, are you dealing with what we call a QSBC, Qualified Small Business Corp? Okay, so ABLE is easier to meet. The rules, the criteria for ABLE is easier to meet than for the capital gain exemption rules. Okay, so there's a difference. Okay, but again, for ABLE, are you dealing with an SBC? And the definition of an SBC is you have a CCPC of which all or substantially all of the fair market value of its assets are used in an active business carried on primarily in Canada. Okay, so basically, we want to make sure that you're investing in a Canadian business that is operating in Canada, because the whole point of this is to incentivize investment in Canada. So, for example, I had a client, they were an engineering firm. Yes, their head office was based in Canada, but they did a lot of work in Africa. So in other words, they had an office in Africa, and they were doing a lot. They had a lot of projects that originate out of Africa. So the problem is, even though they were based in Canada, since so much of their operations was out in Africa, the government said, "Well, I don't want to incentivize you to invest in that business because they're not creating enough jobs in Canada." Okay, so you just have to be careful. It's not just it has to be a Canadian business. It has to be a Canadian business that's really operating in Canada. Okay, and we call this test the 90-50 test. Okay, again, just more for your information, in 4410, when you learn about the QSBC rules, there's multiple tests that you have to look at, and one of the things they look at, we like to call it the 50-90 test into the 90-50 test. Okay, so they have two tests when it comes to QSBC. Okay, so again, for ABLE, you just have to worry about, do you meet this 90-50 test? Do you have 90% of the fair market value of assets used primarily in Canada? Okay, this is the only test you have to worry about for ABLE. Okay, and for this course, we will just tell you if it's an SBC. We're not going to actually make you go through the calculations to determine whether or not something meets the SBC test. We'll just tell you. In 4410, you may be asked to actually do the detailed calculations. Okay? And I'll tell you now, for CPA, you will be asked to do the detailed calculations. Okay? But again, for 3410, we make it a little bit easier for you. We will just tell you whether it qualifies or not. But you have to understand that SBC test is this 90-50 test. Okay, does that make sense? Although that was a mouthful. Okay. Now, for capital gain exemption, the threshold is 866,912, and this amount goes up because it's every year because it's indexed to inflation. Okay, so that's just again, this is just more for your information. But let's go through the handout now to and look through the specific rules. So again, this is the this week 7-8 capital gains PUP example. So the first part we went through last class. Allowable. This is the second part that we're going to go through here. So you have Russell Manning. Okay, he's a professional football player. Okay, and he invests in both public and private corps. So we have three investments. We tell you that he has shares in a public co. He had a capital gain of 15,000. He has shares of another public co, Double E Corp, and he had a capital loss of 25. And then you have CS Corp, which is an SPC, and he had a capital loss of 35,000. Okay, and we tell you that he had $450,000 of salary in 2019. Okay, so the question is, how does the ABLE rule work? Okay, so in a very simple situation, okay, you notice there's no historical capital gain exemption. Okay, no historical capital gain exemption. So in other words, if you have an ABLE, the full amount you'll be able to reclass. There's no limitation. Okay, what you do is, first things first, what you do is you present section 3 and you present it as if there was no ABLE. Okay, so in other words, remember, this CS Corp share, if the ABLE rules did not exist, it would be a capital loss. Okay, so ignore this part here, this ABLE line, ignore it for now. Okay, just ignore it for now. So what you would have done is you would have said, Chris, I had a 15,000 BCL Corp capital gain. Half of that is 7,500. That's in 3BI. Oops. This is the, oh, I wonder if this is the old one. I should have, crap. Okay, anyways, I'll put this in, I'll just put this specific in there. This would have been under 3BIA. Okay, and of course 3BIB, there is nothing, right? We have nothing in 3BIB. Okay, it's 3BIB is a 0. So you would say, Chris, for capital losses, Double E Corp, I would have 12,500 loss. And for CS Corp, again, without ABLE, 50% of 35,000 is 17.5. Okay. Now you sit there and say, okay, it's an SPC Corp. It qualifies for ABLE. So you sit there and say, Chris, how much of this capital loss on CS Corp can I reclass? So you ask yourself, was there a capital gain exemption claim in the past? In this case, you would say no. Then the answer is 100% of this loss, you can reclass. Okay, so how do we show the reclass? Right, we say, well, plus 17.5 here, because then these two numbers net to 0. And then we say we want to move the loss into 3D. So you put there and say ABLE minus 17.5, because you want to say you're moving it from 3B, 2 little I, to 3D. And now because we did that, you can use this 17.5 against the salary. So Russell's NITP at the end of the day is 432,500. Okay, and because now you move this capital loss out from 3B 2 little I, you only have a $5,000 net capital loss carry forward, right? Because before, if I had these both in 3B 2 little I, this would have been 30,000 total. So I would have had 22.5 as a net cap loss carry forward. But again, because I can reclass it out, instead this gets applied against the salary now, and you have a smaller net cap loss carry forward. Does that make sense? Are we good right now so far on this part? Okay. I'm not really sure what you mean by, like, again, Abdurzak, it's not, remember, I'm reclassing. I'm not creating anything new. It's a reclass. I don't want to say 35, right? Because, so again, right, I have 450 salary, half of 15,000 is 7,500. Half of 25,000, right? This loss is 12.5. Half of the 35 is 17.5. Okay? Again, this CS Corp loss, these are shares. It normally generates a capital loss. So the question with Able is, can I reclassify this as an amount under 3D rather than keep it in 3B 2 little I? Remember, 3B 2 little I can only, all right, capital losses can only be applied against capital gains. And remember, right now I only have 7,500 in taxable capital gains. So I already have more than enough allowable capital losses to offset the 7,500. Okay? So if I can reclass the whole amount to 3D, that's great because now I can actually utilize this loss. Okay? So again, at the end of the day, can I reclass the whole amount? The answer is yes. There was no capital gains exempted in the past. So I can reclass the whole amount out from 3B 2 little I to 3D. And that means at the end of the day, I only have 12,500 as an allowable capital loss. Offset that against the 7,500, that's 5,000. And remember, 3B, if it's negative, goes to 0. So 3B is at negative 5,000. It goes to 0. You have a 5,000 net capital loss carry forward. Okay, does that make sense? Remember, because it's reclass, you don't say, "Oh no, Chris, this is 3B too little, 3B too little I. Capital losses is only 50%. 3D is 100%." No, you're just reclassifying the amount so that it's more usable. You do not want to create additional deductible amounts. Okay, so it has to be at 17.5, Adurzak. Hope that helps. Well, we are matching tomorrow. Like you have more than enough. Like you've offset the whole 7,500, right? The whole point is right now, based on these numbers, you have more than enough allowable capital losses. So the answer is, can I do something with this? Can I make this more usable? Right? And again, with Able, with SBC shares, the answer is yes, you can. But the regular capital losses, you can't. You have to keep them where they are. So the double E Corp, it's not an SBC. You cannot reclass that out. You have to keep that in 3B. Okay? So remember, you're never matching losses to particular gains. You're just looking at you look at the numbers in the entirety, right? You have to be very careful. You don't just say you don't match. You're never matching in 3B. Like not on a one-to-one basis. You're looking at totals. You have to be careful in how you're using terminology there. Does that make sense? Are we good so far? Yeah. Yeah. I'm being very um, stubborn on this in a way because people can easily mix up the concepts, and you don't want that. So if we go now to example number 2, again, you have the same situation, but now in the past, the capital gain exemption was applied to shelter some capital gains. Okay. So now the question is, how much can you reclass because you did get a benefit on the gain side in the past? So if we take a look here at the bottom, you sit there and say, well, how much did I lose on my SBC shares? What was the capital loss? Well, the capital loss was 35,000. Okay. what amount of capital gain was exempted in the past? It was 12,000. So the question the government is really trying to ask you is, if you got a benefit on the gain side in the past, are you a net loser or a net gainer? If you are a net loser, then you can still reclass some of your able. If you are a net gainer, then you can reclass none. Okay? Because basically the government is saying, we're only going to give you a benefit on the net, on your net balance. Okay? So in this case, because our SBC loss is greater than the gains that were exempted in the past, the government is saying, "Oh, you're a net loser. You're in a net loss of $23,000. All right, take that amount times 50%, and now my able is 11.5. So this means 11.5 of my 17,500 allowable capital loss on these CS Corp shares, okay? So the 17.5 allowable capital loss of that amount, of that amount, 11.5 I can reclass, okay? And so then I show the reclass over here. And here, let me just fix this one small thing. I just want to add this, just going to put in, again, this is 3BIA, and there's nothing in 3BIB, okay? Just to make that extra clear. Okay, so again, only 11.5 I can reclass. So because I can only reclass 11.5, instead of, I only have now 438,500 as NITP, okay? Whereas in this situation, because I could reclass the entire amount, I had 432,500 as my NITP, okay? So I'm negatively impacted by this capital gain exemption that occurred in the past. My NITP has to be 438,500. And if you take a look at this here, now I net to negative 18.5. And remember, again, 3B is nil. It's a negative 11,000 nil, right? So negative 11,000 here. 3B has to go to nil. I have a net loss carry forward of 11K. Okay. Is it any time in the past? That's correct. I could have had a capital gain exemption 20 years ago, 30 years ago. Is it still applicable? Yes. So anytime in the past. The reality is the government's just going to say, in general, are you a net loser or are you in general a net gainer? That's the question you're always going to get asked. Does that make sense? Okay. So I think that's the biggest thing I want you guys to understand. This is, it's a reclass. And if you, as long as you get that straight, this is one of the simplest rules you're learning post midterm. But sometimes people get confused with the concept of reclass, and if you do, then this topic gets more difficult. But reclass as a concept is very simple, and as long as you got that top of mind, it's fairly easy. Now on your homework, we've integrated one or two other concepts into this. So you're going to have to try and practice your skills with dealing with integrated problems when you get to the homework. No, we will tell you, Adurzak. If we wanted you to actually assess whether or not the company met the criteria under 248.1, we would need to do additional calculations. So there's a lot more work that's involved, and in this course, to try and limit try and make it a little bit more manageable, we're not going to get you to do that. But 4410, you're probably going to have to do that assessment. It's not a choice. It's just, are you going to reclass or not? can I choose, like, I'm not, like, the way you're asking that question, I'm not exactly sure what context you're referring to, Marie, like in your question. Are you trying to say, can a company choose how much able they want to claim? Um, Generally speaking, you do not see companies try and limit their ables. You don't normally think of ables as discretionary. Why? Worst case scenario, let's say you had zero salary in this case. Okay. Is the reclass still worth doing? Yes. Because what do you create? Instead of, if you keep it in 3B, it's a net cap loss carry forward. If you move it out to 3D, even if you don't have any other sources of income, you're creating a non-capital loss carry forward with the ABLE. And that is more usable than a net cap loss carry forward. So you generally don't see people try and discretionarily reduce reduce a claim, ABLE claim, if that makes sense. Okay. And the big thing is, um, the biggest thing to understand is, when would you not claim an ABLE? Well, the answer is, if you already have enough taxable capital gains to utilize your allowable capital losses, then there's no point to claim an ABLE. So that's the only time where someone will say, I choose not to claim an ABLE. It's because they already have a sufficient taxable capital gain to utilize allowable capital loss. So ABLEs only make sense to claim when you do not have enough taxable capital gains. So I don't know if that helps you as well with your question, but when you choose to claim an ABLE in the first place is conditional. I don't know. Does that help you a little bit better? And just so you guys know, in real life, if you file a tax return and you claim an ABLE, it is almost guaranteed that you'll get audited, because it's a big deal to the government when you're reclassing these capital losses. Okay. Any questions in general on ABLEs? Because otherwise, we're going to move on to the next topic. Are you guys good on ABLEs? Okay. Next topic: superficial loss. Um, Let me ask you guys a question. In regular English, when someone says the word superficial to you, um, what do you think? What do you think that means? When you hear someone say to you, that's superficial. What does that mean to you? Fake, made up, surface. I'll say surface, right? It's like just surface deep. When based on kind of what I'm seeing from tomorrow there. So let me ask you this question. Now you see superficial loss, right? So some people say it's like a fake, superficial is fake. So let's just say, superficial loss is a fake loss. So my question is, how do you create a fake loss? Because remember, you have to sell something in order to create the loss. Like, you have to have a disposition. So you have a disposition, you create a loss. How can that be a fake loss? How can that be a fake loss? So I guess Abigail, my question is, in your comment, how can you sell something but still use it? I mean, you guys are kind of, kind of on the right track, but it's just how do you get there? So if you sell it and then you buy it back right away, did you really sell it? Or if you buy something because you know you're going to sell something, like say you know you're going to sell 50 shares, so you buy 50 shares and then you sell it right away. Selling to family? Well, maybe, but it's a little bit tricky there, right? You still have control. Remember, when you sell a share, you don't have the share, so how do you have control? Okay, so it's a little bit tricky there, right? And now some people are starting to throw some rule stuff. So I just want you guys to think of things in conceptually, right? A fake loss, because it's like I like to call this um, the Donald Trump rules of tax, because I look at Trump and I have to say, if there's someone that's superficial, I almost want to say that's him, right? If I want to have like an analogy, uh, of someone who works so hard to just keep his appearance. Doesn't matter if it's good or bad. He just wants to try and keep his appearance. It's a lot of times he says things you don't think it's genuine. Um, and 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 so it's kind of like the same thing with superficial loss rules. You create a loss, but it's not really a genuine loss. So, but I want to show you something. Say you're dealing with a stock, okay? Okay. So let me ask you this question. Actually, let me go 6 months. Okay. So let's say you are holding Royal Bank shares. You bought the shares right here in February, and now the shares have dropped a ton, and you're now March 12th. Okay. So you you could say for sure, Chris, it's a superficial loss if I sell the shares in March 12th and I buy the shares. Um, and let's say I sell the shares in March 12th. I bought it here at the peak at 108. I sell at this trough here at 72, but I buy the shares back right away. Is that superficial? Yeah, because did you really sell your shares? No. Well, you sold them and you bought it back. So you say, Chris, that's superficial. Now here's a question. What happens if you sold here at 72, the shares rebound, and you sat there and said, I'm going to buy the shares back April 23rd? Or no, let's say I bought the shares here, April 3rd. Okay. Is that a new decision? So I sell March 12th and I'm buying the shares April 3rd. Here, let me do full screen so it's not as um, it's larger for you guys. Okay. So right here, I panicked. I sold around this point in time. I think this is March 12th. So I sold right here, March 12th. I panicked. I sold it March 12th. And then I said, oh, you know what? I think things are doing better. I'm going to buy here at April 3rd. Is that a new decision? Right? If I sell on March 12th and I buy March 12th, that's clear. That's not a new decision. But if I sell March 12th, I buy April 3rd, is that a new decision? Are you really saying the loss I had March 12th is still fake? How could it be fake? We're not able to predict the stocks. True, to a degree, but the problem is, at what point when when we say something is a fake loss, what are you basically saying? You're saying you didn't really sell the stock and you didn't really make a new decision. You didn't make a new investment decision. Well, now some time has passed. Is this enough time to be able to say that's a new investment decision, Keegan? Because that's really the question that you're trying to answer for tax. Did you make a new investment decision? If the answer is no, then the loss you generated was fake. But if it's a new investment decision, then it's not fake. That's the concept, if that makes sense to you. Does that help you a little bit, Keegan, like in terms of what we're trying to achieve? But the question is, like I sell March 12th, I'm buying in April 3rd. Do you think this is a new investment decision? Seema says no. Why do you say that, Seema? Why would you say that? Okay. So if I buy the stock right now here in June, are you telling me that it's the same stock? Are you telling me that's not a new investment decision? Oh, Goosen, stop talking. Stop going to the act. Stop cheating. I'm talking conceptual right now, Goosen. Because I would tell you right now, to me, based on the circumstances, that's a new investment decision. Okay. But what's the problem? This is very subjective. Okay. This is very subjective. How do you, if you're the government, how do you enforce this is a new investment decision? Okay. Imagine if you were over here in the curve. Okay. This is October 3rd. And now you decide to buy the shares again, November 11th. There's not much change there. Is it a new investment decision? Maybe. So again, I sell it here in October. I buy here in mid late November. Is that a new investment decision? To sell here, buy here? Well, maybe, right? So the question becomes, should the value of the investment drive your decision? I would tell you, not necessarily either. Because if you think about an investor mind frame, the real issue for them is at any point in time, if I sell or buy, is the sentiment that the stock or what that I'm buying, is it going to grow in value? If I think it's going to grow in value, I want to own it. If I don't think it's going to grow in value, I want to sell it. And how you assess that can change depending on facts. And if you're the government, that's very difficult to determine for every individual stock. Okay, so the concept behind superficial loss is it a loss a fake loss? Did you, when you sell something and buy something, or if you bought something first then sell it, regardless of the situation, when you were doing your buy or your sell, was that a new investment decision? And if the answer was no, then to me that, to the government, that's a fake loss. The problem for the government is, how do you determine whether a decision was a new investment decision or not? And that's why they have to create the superficial loss rules in the way that we're going to explain it. Is because rather than try and make a decision based on subjective criteria, they made a hard criteria, so it's just easier to apply the rules. Okay? So just you have to understand that it's very difficult for the government to qualitatively make the decision. So they have to set some hard criteria in these rules in order to come up with, in order to be able to police this situation. Okay? So under superficial loss rules, there are 4 triggers. Okay? There are 4 triggers. Okay, so we're going to go through exercise 8.2 on page 356. And as we go through that example, we'll talk about the triggers and the things, the specific things you need to look out for. So first off, please turn to page 356 in your textbook. Just throw a note in the chat. Let me know when you're there. Okay, so let's go through this. So I'm just going to say exercise A2, Nadia Kins. Okay, so in this example, they tell you you have Nadia Kinsky. She has 1,000 shares. Oops, of Board Limited. Okay, and she tells you, okay, cost base is $23 per share. Okay, so that means your total ACB equals 1,000, right? Or 23,000 total. Okay, so then she tells you August 20th, 2019, she sells all of these shares at $14.50 per share. Okay, so you know right away, right? 23 is your cost. You sell them for $14.50. She has ultimately generated a capital loss. She sold these shares at a loss. August 25th, she acquires another 600 shares, and she spends $13.75 a share. And she still holds the shares at the end of the year. Okay, so the question is there a fake loss in this scenario? So here are the triggering events. So if you look at this, the rules for what is a superficial loss is defined in section 54 of your act. Okay, but the basic criteria is this. Number one, is there a disposition that results in a loss? Okay, so you would sit there and say, yes, Nadia sold 1,000 shares of Board Limited at a loss. And the key thing is the date, August 20th, 2019. Okay. Okay. So that's the first step. Then you sit there and say to yourself, all right, we now need to figure out, has there been enough time between when we had our disposition that results in a loss and the purchase? Is there a sufficient time lapse between acquisition of what we call the substituted property and the disposal to say this is a new investment decision? So how does the government define that there's sufficient time? Okay, the government says this: was there purchase of substituted property within the specified time period, which is 30 days before and 30 days after the disposition date. Okay, so in this case, what is your disposition date? You sit there and say, well, what day was there the disposal that resulted in a loss? It's August 20th, 2019. Okay, so what's 30 days before August 20th, 2019? Anyone? So the month before is what? July? July is a 31-day month. Correct. So 30 days, right? So there's 19 days in August, right? Because you remember, it's before August 20th. So it's 19 days in August. And then you have another 11 days in July. So 31, 30, 29, 28, 27, 26, 25, 24, 23, 22, 21. So you would say July, so 30 days before August 20th, 2019 is July, that's July 21, 2019. What's 30 days after August 20th? Again, August is also, right there, I think if I remember right, August is a 31-day month. So that would be September 19, 2019. Okay? So basically, was there a purchase between August 20th, sorry, between July 21st, 2019 and September 10, 2019? Okay? 3. Number 3, who acquired the property? Because if the tax, obviously if Nadia buys the shares, right? So she sells the shares and then she buys the shares after, for example, obviously that could be a fake loss. But what happens if Nadia's spouse acquired the property? Is that fake still? Right? And some people would say, well, you know what? The spouse is so closely related, like there's the relationship between between spouses or husband and wife is so, that is so close. They are so, they are not arm's length from each other. They are people that would work together in their common interest. So that's superficial. They would say, that's still fake. It doesn't matter if Nadia didn't buy, if her spouse got it, that's still fake. Okay? So the question becomes, well, how do you define affiliated? How close does the relationship have to be? Okay? And the answer is, for affiliated, two people are affiliated if it's the individual and their spouse or common law partner, or if it's the corporation, if it's between a corporation and the person who controls the corporation. So, for example, if Nadia owns Nadia Corp, Nadia Limited, and Nadia Limited buys the shares, well, they're affiliated because Nadia controls her corporation. Okay, that's also a no-no. But what you'll notice is, say, for example, Nadia's sister bought the shares. Well, Nadia and her sister are not affiliated. Okay, so it's only spouse or company or corporation that the person who that the taxpayer controls. Does that make sense? Around the definition of affiliated? Okay. So in this case, we would say Nadia acquired 600 shares after. So I should say here. So just to complete the loop before I go too far ahead, right? So Nadia substituted. So 600 shares were purchased on, what was it again? It was on August 25th. No, stop it. Okay. Number 3 was a substituted property acquired by the taxpayer or affiliated person. We would say Nadia acquired. Okay. And the last one is at the end of the 61-day period, did the taxpayer continue to hold? Okay. So in other words, what the government is saying is, if you bought the shares within this time period, and then at the end of the period you didn't sell it again and you just held it, well, then you really did make a new investment decision. The loss is fake. Okay. So in this case, you would say Nadia continued to hold the shares. Okay. Then okay. And I have to really make sure this is emphasized. All 4 triggers have to be met. If one of these triggers are missing, you do not have a superficial loss. Okay? All 4 triggers must be met for you to have a superficial loss. And here's the key thing. This loss on August 20th, 2019, is all of it superficial? How much is superficial? So, Tarangate, why is 400 superficial? Why are you saying 400 sale 400 shares is fake? Never mind yet. So, like you would say, Chris, what happened at the end of the day? Before all these events, Nadia held 1,000 shares. At the end of the day, she has 600 shares. So she really sold 400 shares, but 600 was fake, right? So in this situation, a portion of the original capital loss is realized, a portion of the loss is fake, okay? So what do? You sit there, now, for a superficial loss rule is very important. You always clearly indicate what person is experiencing the tax consequence. So you always say, for example, in this case, I would say, first off, Nadia Kinsky, right? I would make it really clear. This is Nadia's tax consequences, right? At the disposition date, she had, right? At the disposition date, she had proceeds, right? 1,000 shares, right? So number of shares. proceeds, right, per share, right? I think it was what? I think the question said was $14.75 a share. Let me just go back here. No, she got $14.50 a share. Okay, so her total was $14.50. Okay, $14.5. For ACB, again, 1,000, 23. I guess I should just say per share, right? Was 23. So again, her cost base was 23,000. So she had a loss. If I just do this, she had a loss of 8,500. Okay, and at the end of the day, 600 shares were held at the end of the period. Nadia started with 1,000, so therefore 60% superficial and 40% realized. Okay, so you would sit there and say, Chris, her realized capital loss is 40% of that 85. Her superficial is 60%, which is the 5,100. Okay, you guys following me so far? So this, you would say, allowable capital loss is 1,700. This, pursuant to 40 bracket 2 bracket G, is nil. Okay. Does that make sense so far? At this point, are you guys following me up to this point? So basically, government is really saying this is my fake loss right here. Okay. Okay. So now the question is, great, this is fake. But the reality is that doesn't mean I should lose this cost base. Because right now, if I just say nil, it's as if I just lost this $5,100 becomes a nothing. And it feels bad if I just lose it. Right? The real issue is if I sold this stock in the future for good, and that is a real that could still become a real loss. I really shouldn't lose this cost base for nothing. So the government, and I should let me fix this typo there. Show. Okay. So the government said, okay, what we'll do is the denied loss gets added back to the cost base of the substituted property. So again, we look at the substituted property. Okay. Nadia bought what? 600 shares, right? So the ACB, she bought 600 shares and she paid $13.75, right? So on August 25th, when she bought the 600 shares, she paid $13.75 a share. Okay, so you'd say, Chris, based on what was paid in cash, the cost base of those shares is $82.50. Okay, but what the government says is, well, you shouldn't lose this cost base. Add the superficial loss. So in this case, add the 5,100. The new ACB of the substituted property is 13.1. Okay. If I sell these shares in the future, now that's when I realize this loss. Okay, because now what happens is I've added to the cost base. It's going to reduce any future gain. I'll basically realize the loss in the future when I really sell it. But the key thing is the loss, the denied loss goes to ACB of the substituted property in the future. And in this case, since Nadia sold the shares and bought the substituted property, she gets all the consequence. If we had instead, say, Nadia's spouse bought the shares, then this part would be Nadia, this would be the spouse. You would have to clearly indicate this is the spouse's consequence. Okay? So the key thing with superficial loss is the denied loss stays with the property. It does not necessarily always stay with the same person. And that's important because later on, if you ever go into a career in tax, geez, why am I so terrible at spelling, typing this stuff? When you go on to a career in tax and you look at corporations or other type of persons, stop loss rules keep losses typically with the same entity, not with the property. So there's differences between what happens for individuals versus other persons like corps or other entity types like partnerships. Is that clear? Yeah. So one of the things that you need to know is for the custom problem that is in the homework, the custom problem is going to ask you a question. And the question says, basically, in this scenario, she had 1,000 shares. She sold the 1,000 shares. Then she bought 600. And the question is, what happens if rather than sell the 1,000 and buy 600 after, what happens if you buy 600 first, then you sell 1,000? So you start off with 1,000 shares, but rather than you sell all of it, then buy your substituted property, what happens if you buy 600 shares first, then you sell your 1,000? Your endpoint is still exactly the same, but the order in which you do your sale and your purchase is different. Do you get the same answer or do you expect a different answer? Okay, so that's the question that is posed to you in your custom problem. It doesn't take long to do. It's more of, can you think through what the end result will be? And the key thing is you will have to think about, is there any other rule that was taught in last week's lecture that could apply if the order is different? Okay. So in other words, there is some degree of integration in your custom problems. Both able and superficial loss has a degree of integration in the question. So you need to think through what if other rules apply, what is the impact? Okay? So just keep that in mind. We're having, you can say, a little bit of fun in the homework this week. Okay. Any questions overall on superficial loss? Are you guys good? Okay. All right. So I'm going to, yeah, okay. I mean, I'll let you guys take the notes down on this one. So, okay. So we walked through that. All right. So let's go through some stuff on the course site. Let me just view things as a student so I don't inadvertently show something I shouldn't show. Okay. So right now, in terms of week 8, um, you've got, this is your homework right here. 3 of the key topics we have taught. I do have some time to teach principal residence, so I'm going to go into that in a minute. So just bear with me here and just make sure I've got it here. Okay, so we'll go into that in a second. Um, I'm going to skip over foreign currency for now. If we have enough time in the class, we'll jump back to it. But for principal residence, what I want to highlight to you guys is there's this homework remediation presentation. And I've revised the dates on this um, because this was somewhat dependent on when I would teach principal residence. And this is something that I've been doing now for the last couple of classes because I think it's a topic that a lot of people are interested in. So this project, so remember before when I talked about participation, I said to you guys in class, 5% will relate to a project. And you had your first crack at this on the COVID-19 office expenses. Okay, at the crack at the 5%. And I'm gonna change my participation criteria in a minute, but let me explain this presentation first, and then I'll talk about the changes that I'm thinking of doing, and we can talk about whether you guys think it's a good idea or not. Okay. So in terms of this presentation, this project focuses on a situation where if you had a rental helper, so again, most people, they say principal residence rule. The general rule is if I own a principal residence for tax purposes, I sell it, the gain on that principal residence is tax free. Okay, that's the general concept. Um, Now, what happens if you have a tenant? Okay, and the question is, when you have a tenant, so say you had a house and you renovate the house to accommodate a tenant. Because let's just say, for example, you're trying to earn some extra cash. Maybe you lost your job due to COVID. Maybe, housing is so expensive in Vancouver, you need to have a mortgage helper. So you renovate your basement and you accommodate, and now you have a mortgage helper. The question is, did you now screw yourself on the principal residence rules? And remember, what's the issue? When you convert a space from a non-income producing use to an income producing use, you now have what we call a change in use and a deemed disposal. And more importantly, how can you say you are living in your basement? Someone else is living in it, you are earning rental income off of it. That basement is no longer a space that you live in. So, inadvertently, by renting out your basement, did you disqualify yourself from qualifying for the principal residence exemption? And you have to think, imagine you bought your house 10 years ago, 9 years ago, 8 years ago, even 4 years ago. Do you think you have an accrued gain on your property? Has real estate in Vancouver gotten any cheaper? I don't think so. Not really. Even COVID has not really impacted the valuation of real estate in Vancouver. So now, do you think it's a big deal if you screwed yourself on the principal residence exemption? Do you think this is a topic of interest to most of you guys in this classroom? So, here's the fun part. The question, so I've posted a whole bunch of CRA documents. There's a Word document that discusses what we want you to think about. But the real question is there any administrative relief? Is there anything that can save yourself from not being in violation of the rules? And the key thing here is years ago, for many, many years, the government did have something that might save you from violating your principal residence rules, but they were not very clear. And this CRA views in focus, this especially this document, the CRA basically said, let's post something and clarify when we might give you relief and when we won't give you relief. And this guidance shocked some people because it actually made it so that it was actually more difficult to get relief. So the whole project is kind of centered around these documents. Okay, so this is the post midterm presentation. And basically what I'm going to do is, for those who wish to submit, rather than make these presentations worth 5%, what I was thinking of was making these presentations worth 15%. So just for context, the plan was before, for participation, I would do a quiz for 5%, a surprise quiz at some point in time. Obviously, if I were to continue on this course, there aren't too many weeks left, so a quiz would be coming soon. So I would do 5% for a quiz, 5% based on marking of a homework, and 5% based on one project. And so basically what I would propose now is doing one of the presentations could be 15%. If you have done the COVID-19 presentation, that is worth, we would be making that one out of 15, and I would post a mark. So that would be based on the project. Or if you want to give yourself additional chances to earn marks on the presentation because you weren't confident on the COVID-19, and I'll talk more about what we were looking for again in COVID-19 in a second, then you could do this project and top yourself up to 15. So again, you're not going to get penalized if you did not do the COVID-19, because we're changing how we're doing things. And again, if you did COVID-19, what it would do is make it easier for you to get to 15 on the presentation. So the question I have is, do you want to do you want me to switch to that, or do you still want me to do my 5-5-5? So the quiz, marking of the homework, and the presentation. So I'm going to do a poll right now, and I want you to vote. Do you want to switch or not? And just so before you do the vote, I'm just going to quickly talk about COVID-19. I will tell you again, on the COVID-19 presentation, the right answer was to say that employees would not be able to claim expenses if they only were working from home for a short period of time. And to also say, because there is likely no contract for people to that says that people were required, like people did not do any contractual agreement in most cases to say you must work from home, because there's no contractual agreement. It's very difficult to qualify for deductibility of expenses. That was a general gist, and I can tell you no one got that. So on the presentation, most people at best would have gotten, I would say, based on effort, most people would have gotten about 70% on the project. Again, I wasn't expecting that everyone was going to get it right, but I will tell you, on average, most people would have only gotten about 70%. Okay. But again, no one would have failed the project, because again, as long as you put a reasonable effort, you easily would have passed the project. Most people would have gotten 70% because they didn't hit it right on the head, but you would have gotten pretty good just because of effort. Okay. So again, I'm going to put the poll up, and it's going to be two answers: switch or no switch. Okay. It's going to be A or B. A, again, I'm just going to sit there and say A is switch, B is no switch. Keep the quiz, keep the homework marking, and just 5% on projects. Okay, again, A is switch, B is no switch. Keep the whole um, keep the whole quiz and whatnot. And the quiz, of course, would be my quiz. The quiz would not be a standardized quiz. It would be my own personal quiz. Wow, I'm surprised. It's really even. Okay, here, let me redo the poll. Okay, let me redo the poll. Sorry, let me put it on the screen. So let me make it clear. Um, all right. So let me put the poll question. Otherwise, maybe I should really do this. So the poll question is initiate the switch. Presentation would form the, I'll just put in there, principal residence project. Okay, sorry, I should say this is A. Okay. So in other words, I'm not saying no. You still have to do a project if you want 5%. Okay. This is not like if we do homework quiz, there's no project. No, you still have to do the project. And again, if you did COVID-19, then you would already get, for almost all, it'd be 70% of the 15%. So you would already get, was it 70%? For those, I'll tell you now, for most people, pretty much everyone was around the same on the project because when I looked through the projects, I pretty much had the same um, criticism. So zero point 0.7 times 15. So most of you would already be at 10 and a half if you did the COVID-19. If you did not do COVID-19, I would just take whatever percentage grade that I would give on the principal residence project, and then that would be applied to the 15. So you don't lose out basically if you didn't do it. No, there will be no other presentation. It will just be on this. Uh, the other presentation I did in the past, I'm not going to be doing that one because I feel like that one is that one. There's the reality is for me is if to keep that project, I probably should have more CRA resources, and we don't have that yet. So there is not. And if you're asking me what is the due date on the presentation, the due date for submission, if you want to present in the class, and again, that's dependent on people, doing a reasonably good job on initially, would be on on Thursday of this coming week. But I will allow submission up to the beginning of next class. So there is a timing issue there too, which is why I have to ask the question. I can't just, I'm not going to just unilaterally do it. So the question is, I've initiated the poll. Okay, do you want to switch it or not? Because again, I'm still requiring a project. So you're either going to get the COVID-19 or you do the principal residence, but there's no change. If you want the 5% even on B, you still got to do the project. So I'm doing this because I think it's actually easier for you guys. Like I think it's going to help you guys manage things. But I'm okay. I already have the quiz in mind, already designed. I'm easily can stay with the original course if that's what we want. Okay, I guess I don't know. I guess that poll is conclusive, right? Joshua says, if we do A, can we still have a quiz? What do you guys think? Do you guys still want a quiz? Let me put it this way. The whole point of the quiz was to get you to study ahead of time. So um, if people are not going to take the quiz to the point where you're going to study hard ahead of time, then the answer is I'd rather save it for another time. So I don't want to. I'm not going to do this quiz and just have 3 people, 4 people want to do it for practice. I'd rather save the questions and use it to challenge people another time. Because my quizzes are not, they're fairly complex. Like if you think about the multiple choice from last time, uh, those were challenging. If we do, I rather do the quiz for marks. That's the reality. Like I really want this to be worth something. So if I'm going to do a quiz, it's going to be for marks. So I can do 10% for projects, 5% quiz if that's what people want. Okay. But the quiz, just so again, I'll put the poll up again, but just remember before you guys complain, the quiz, the multiple choice would be equal to the difficulty of the multiple choice we did for the midterm. Okay. So just I'm going to put it in here. I'll put it in here. Change. Okay. So I'll put A, B, and C. Okay. B is initiate the switch, but presentation worth 10%, and there would be a quiz at worth 5%. Difficulty equivalent to mid. Like I want to make it really clear. This is not MyLab difficulty. MyLab was way too easy in my mind. Okay. So it's more equivalent to the midterm prep. Okay. So I'll put that quiz up there. But it would be at 5%. Okay. So let's initiate a poll. So now it's A, B, C. I think some people would love the challenge. I think some people think I can't challenge them hard enough. Oh, come on. Where's all the people that wanted the quiz? A bunch of you are saying you want the quiz. Okay, so right now, I think overwhelmingly, only a couple people want the quiz. Most people don't want the quiz. I think that's pretty clear. And there's like 5 people that just are like, I don't care. Either I've slept at the keyboard or I don't care what everyone else wants. Okay, so it's decided. That's what we're doing. Just all on the projects. Okay, so that's designed. That's done. So I'm just going to now teach principal residence really quick, the basics, and then we'll talk. There's 2 people that I need to talk to at the end of the class. Okay, or maybe two people. Okay, let's go into principal residence. So, what I want you guys to think about with respect to principal residence, okay, is go into the act, and what I want you to do is look at the definition of principal residence under section 54. Okay, I want you to go into the definition of principal residence under section 54. And what I want you to do is I'm going to ask you this question. If you own, let's say you had two residences, okay? During the year, you had, say you own a house in Vancouver. Say you're rich enough, you own a house in Vancouver. You spend 8 months of the year in Vancouver. Now, let's just say in the summer, you decide to go to your cottage in Kelowna. Forget about COVID-19. Pretend COVID-19 didn't exist, okay? So you go to your cottage in Kelowna, and you spend your summer there in Kelowna. The question is, are both properties principal residences for tax purposes? Okay, so I want you to go to section 54 of your act, because in order to understand why the rule is designed the way it is, you need to first understand what is a principal residence. Okay, so take a look at section 54 of your act. If someone can just throw out the page number, I'm just looking through my tabs right now to get there, but if you're already there, throw the page number out. Oh man, so many tabs in this act. Okay, it's on page 260. Okay, 260 if you've got the old act for principal residence. So just look at up to paragraph A. Don't go beyond paragraph A. Answer the question. If I have a house in Vancouver, I spend 8 months there. The rest of the year in the summer, I spend at the time in Kelowna in this cottage. Are both properties principal residences, or is only one a principal residence? Abigail says just one. Why? What words make you say it's just one, Abigail? Because normally you hear the word principal. Principal usually in the English language means main residence. So that implies that there's just one. But in terms of what you read in the Act, what words in the Act tell you that there's just one? Or if you disagree with Abigail, what words in the Act tell you that there's more than one? Like, what are the key words in that principal residence definition? Remember, pretend you're a tax person. What words? What specific words? Inhabited? Okay. Okay, so inhabited is certainly a key word, but here's my question, Yu Yang. Did you inhabit both the Kelowna cottage and the Vancouver home in the year? Did you live in both places during the year? What do you think, Yu Yang? Did you inhabit? Because I will tell you now, if you just look at inhabit means did you live in the property? So from a tax point of view, did you live in the Kelowna house? The answer is yes. You spent 4 months there. You didn't live there for the whole year, but did you live in the property during the year? Yes. Did you live in the property in Vancouver home during the year? The answer is yes. And here's the other key word. There's a word that says it's before inhabited in the act. It says in paragraph A, It says ordinarily inhabited. And ordinarily means habitually. Did you regularly inhabit? So if you regularly live in Kelowna, even if it's only for 2-3 months in a year, and you regularly live in Vancouver year after year after year, the answer is both properties are principal residences for tax purposes. So you can actually have more than one principal residence in the year. Okay? You can have more than one property qualify. And this is the key word. The properties themselves can qualify. And now you sit there and say, Chris, this doesn't make sense. Because then that means principal means one, like the main. Well, how is it you can have more than one? So what the government said was, I don't want to make it so that you can have all these properties tax free. So what happens is, first you must decide, does a property qualify? And then you have to sit there and say, every year that I've owned a principal residence, every year, I'm going to designate a qualifying property, one qualifying property as the principal residence. Okay? And then what happens is, when I try to calculate how much of a gain is taxable on a principal residence, I have to go through and calculate the amount that's exempt under 40 bracket 2 bracket B. And what that says is, to figure out your gain on a principal residence, take your gain, which is what is here in A, minus the part that is exempt. So this portion that I'm mousing over, this portion represents the part that's exempt. And the part that exempt is basically take your gain, times it, and you say, ignore this D. This D is a rare circumstance. Basically, it says, of the years you've owned the property, how many years did you designate it as your principal residence? So if you own a property for 10 years and 5 years you designated it as a principal residence, then half of the gain will be exempt. Okay? But the only tricky part about this is there's also a free year. So in this case, if I designate a property for 5 years as my principal residence, well, for the purpose of the calculation, I go 1 plus 5, 6 years is my numerator, 10 is my denominator, because that's the number of years I own the property. It's 6/10 that will be exempt. Okay, so the free year kind of throws a wrinkle in terms of the rules. Now you might sit there and say, well, Chris, why do I have this free year? So I want to give you this example. Imagine 2000, you buy a property, okay? And you say, Chris, all right, I sold that property in 2005. Okay, so when you sit there and say, well, how many years did I own the property? 2000, 2001, 2, 3, 4, 5, 6 years. Remember, you have to include the initial year. It's not 5 years, it's 6 years, because 2000, 01, 02, 03, 04, there's 5 years, 05, 6 years. Okay, so as long as it's any part of the year I've owned the property, then you consider that a year in which you own the property. Even if you only owned it for 5 days in January, well, you still have to include that year in terms of the number of years owned. So you have this property for 6 years. You sell the property in 05. If the government didn't give you the free year, what would happen is you would say, okay, Chris, I sold this property 2005. I held the property for 6 years. I'm going full exemption on that property. So for 2005, right? So 2000, 2001, 2, 3, 4, 5, this property, this first Vancouver house, I'm going to designate that as my principal residence. Now let's say I sold that house, and now say I buy a house in Burnaby. So Vancouver house is completely exempted. I buy my house now in Burnaby. What's my problem? When I sell my house in Burnaby later on, guess what? The year that I would be considered owning that property since 2005, but I cannot designate that house in Burnaby as my principal residence because I used it on my Vancouver house. So Even though I've only owned one house at any particular point in time, if the government never gave me the free year, I would have to pay tax, some amount of tax on my principal residence in a situation where I bought and sold a house in the same year. Does that make sense why they have to give you the free year? Does that conceptually make sense? Okay. Anyways, so what we'll do now, so the thing is now is when you deal with, well, you, the taxpayer, you make the choice. Okay? You're the one that designates the owner. So to illustrate the rules, how they apply, let's go to exercise 8.8 and 8.9. These are fairly quick exercises to go through. So in 8.8, you have Norm Craft, and we're just looking at the first property. So in that property, he sold, hold on a second here, I just want to, okay, so in Norm Craft, he had a first home, he purchased it at cost $89,000 in 2010. 2015, he sells the home, okay, for 109.5. So in this case, 109.5, he bought it for 89, your cap gain is $20,500. Okay. Now you sit there and say, what is exempt? Well, he owned the property for 6 years. So he could designate this property all 6 years and he has 100% exempt. But you have to remember, because you have the free year, you don't even have to designate all 6 years. He can just designate 5 years and he'll have it all exempt. So he can say to 2010, 11, 12, 13, 14, I designate this house as my principal residence. 2015, the year in which he still lived in the house, but then part way through the year he sells it, he can say, I'm going to use my free year on this house, and all of the gain will be exempt. Okay, so he doesn't have to designate the house in 15. He just says my free year will be 2015. Exercise 8.9, okay, where you have now two principal residences. Okay, so you have Yan Sadat. He owns a house in Ottawa and a cottage in Westport. For those who want to follow this, I should say this is page 366 in your textbook. Okay, there were proceeds of what they had two residences. The Ottawa house was purchased in 08 for 126. The cottage was gifted to her by her parents, right? So remember, that's a deemed disposal by her parents. Fair value was $85,000. So she acquired it for 85 on the deemed disposal. Okay. But she acquired it in 2011. In 2019, she sells both properties, and she sold them for 198 for the house and 143.5 for the cottage. Okay. So the question becomes, she lived in Ottawa during the year and spent her summers in the cottage, so they both will qualify. What amount is taxable in the situation? Okay. So because you own the Ottawa house since 2008, okay, you own the house since 2008, that means, and you sell in 2019, that's 12 years. Okay, so you've owned a principal residence for 12 years. So you sit there and say, well, in a multiple property situation, the real question is, how much is 1 year exemption worth for every property? Okay, and so you sit there and say, well, the best way to figure that out is just like in managerial accounting. Let's just figure out my number of years is my limiting factor. Let's figure out, if I allocate 1 year exemption to the home versus 1 year to the property, which one has the higher capital gain per year. Okay. So in the case of Westport, you would say, oh, look, 58, this is my capital gain, it's 58.5. This is my capital gain on the home. based on the number of years I've owned the property, 1 year exemption is worth 6,000 on the home. 6,500 is what 1 year is worth on the cottage. So you sit there and say, well, that means I want to maximize my exemptions, the designations on my cottage. So remember, I get my 1 free year. So that means I need to designate 8 years to the cottage. Since I've owned a property for 12 years, that means I have 4 years to designate to the home. Okay, because remember, every property gets its free year. So what would that mean? Say for your Ottawa home, you would say, let's do, sorry, I will designate it as my principal residence 2008, 9, 10, 11. And I'll say free is 2012. For the Westport Cottage, remember, the Westport Cottage was gifted to her in 2011. So we might say, let's make this the free year, designate these other years, the cottage is a principal residence. Okay? So when they do the designation, this is what it will look like. Okay, so you asked me, Chris, how did you get 5 exempt years for the home? Well, free year plus 4. How did I get 9 for the cottage? I designated 8 years plus the free year. That's how I got to 9. Okay, so basically by doing that, you get 42% exempt on the home, 100% exempt for the cottage, and that means of the 72,000, 30,000 gain exempted on the home, 42 is a capital gain that's realized. For the cottage, 100% is exempted, so there's no capital gain. Okay, does that make sense? Are you guys good there? Yeah. We will go through the change in use rules next class, right? But again, we kind of explained it briefly. Change in use, where something is income producing and you use it for non-income producing, you have a deemed disposition. Same thing when you go the other way. And that's what's driving that principal residence project. Okay. So give the principal residence project a whirl. There is also, if you want to get more understanding on principal residence, in the course site in next week. So if I go to quickly to the course site in week 9, there's a handout you can download that talks about changing use and principal residence in more detail. But again, we will talk about this more next class. The project is right here. This is the guidelines. It's right there. There's a submission box. June 19th. Next class. Sorry, June 19th. I'll change this to be midnight. It should be midnight. I don't know why it says 11:30. And again, I'm going to change the date. Thursday is for the due date will be for those who want to be considered for in-class presentation. So I'm going to refine these dates in a second. That's right. The class said option A. They don't want a quiz. Not for marks anyways. So it'll be option A. Okay, Claudia, I need to talk to you, so please stay on. And I think Tamara, you had sent me an email, so I didn't know if you wanted me to talk to you after class as well. I don't know if tomorrow, if are you okay? Do you want to talk after now, or do you want? Like I need to talk to Claudia first, but after I talk to Claudia, um, no, Kyla, if you did not do COVID, then the principal residence will be worth 15. So like basically, if you did COVID, you would basically get 10 and a half out of 15 right now for those who did COVID. So they're doing this for basically to try and get another 4.5%. If you did not do COVID, then this presentation will be worth 15. So you still can get the full 15%. So you're not penalized. You're not penalized if you did not do COVID. Yes, a number of you already did COVID, so a number of you are already at 10 and a half out of 15. Because all the presentations for COVID were around the same quality. So yeah. So for those who did COVID already, then you're still doing 4.5. But you're again, I'm not going to I'm not going to say to people who didn't do it that you can't get 15. I think you still should be able to get 15. Okay. Okay. Tamara, do you want to talk after class, or are you good? Because you sent me that email, and then so I don't know if you want me to talk to you personally or not. I think it was you that sent me that long email, right? Oh, I don't want to check now on the screen. Oh no, it's Taryn. Yeah, it was you, Tamara, that sent me that question. Oh no, was it Taryn Deep? Uh, oh, sorry, it's Taryn Deep. Sorry, I'm missing. It was Taryn Deep that did it. So, do you want to talk after class, Taryn Deep? Okay. So let me talk to Claudia first. I'm going to set the virtual classroom thing for Claudia first right now, and it is very quick. So, is there anyone who has any other questions? Otherwise, I am going to have to leave the class. Uh, no, I'm not. I don't